Yogah Karmasu Kaushalam.
I, Dr. Sweety Shah, thank UGC Human Resource Development Center of Gujarat University for giving me an opportunity to connect with you all and deliver my session on behavioral finance. I also thank Dr. Jagdish Joshi, Professor and Director of UGC Human Resource Development Center of Gujarat University for providing this opportunity. We all in team have developed lots of content on different subjects for students as well as faculties. Human Resource Development Center, Gujarat University is ranked as 15 in India and number 1 in Gujarat. It is pioneer and created benchmark by organizing the first of its kind online refresher course in India in the year 2018 and 19, where about 2,500 participants have attended it, and the first online professional development program for the administrative staff of universities during lockdown with 105 participants. Psychology needs money. Behavioral finance. So today's topic is the irrational influences in investment decisions. Behavioral finance, how it has originated. From the mid-1950s, the field of finance has been dominated by the traditional financial models developed primarily by the expert economist. So the central assumption of the traditional financial model is that people are rational. However, psychologists challenged this assumption. They argued that people often suffer from some of the biases and act in a seemingly irrational manner. The finance field was reluctant to accept the view of psychologists who proposed the behavioral finance model. Indeed, the early proponents of the behavioral finance were regarded as heretics. As the evidences of the influence of psychology and emotions on decisions became more convincing, behavioral finance has received greater acceptance as well. So now how behavioral finance is different from the traditional finance? Traditional finance assumes that people process data appropriately and correctly. In contrast, behavioral finance recognizes that people employ imperfect rules of thumb to process the data, which induces biases in their beliefs. Traditional finance presupposes that people view all decisions through the transparent and objective lens of risk and return, whereas behavioral finance postulates that perception of risk and return are significantly influenced by how decision problems are framed. Traditional finance assumes that people are guided by reason and logic and independent judgments. Behavioral finance, on the other hand, recognizes that emotion and herd instincts play an important role in influencing financial decisions. Traditional finance argues that markets are efficient and the price of each security is an unbiased estimate of its intrinsic value. Whereas behavioral finance says that behavioral biases and effects of emotions and social influence often lead to discrepancies between market price and fundamental values of the security. So here I use the term behavioral biases. What are these behavioral biases? Behavioral biases are actually the irrational beliefs or behavior that unconsciously influence our decision-making process. So always the smart investors avoid these biases and controlling them can allow this investor to reach a decision based on available and factual data. But why we need to understand these behavioral biases and why they are important to us. These behavioral biases are not only important to us as investors, but also to the advisors. With the help of the understanding of these behavioral biases, advisors are able to improve economic outcomes. It also helps in the achievement of the stated life objective as well as the financial objectives. It can also save their clients from potential financial crisis and disasters. It will also help them to improve the overall quality of their financial decisions. And lastly, the modification or the adaptation to irrational behavior may lead to the superior results as well. So it is important for advisors and the wealth managers to be aware of such biases and the mental shortcuts that can impact their decision. By learning about the nuances of observed behavior in the market, investors can even learn to mitigate and prevent the future errors. These behavioral biases are actually categorized into two parts. One, which is the cognitive biases, and the other, which is emotional biases. What is cognitive bias? Cognitive bias is actually a systematic error in the thinking that occurs when people are processing and interpreting information in the world around them and affects the decision and the judgments that they make. These cognitive biases are actually bifurcated again into two subcategories. One into that is the belief perseverance biases, and the other one is information processing biases. Belief perseverance, also known as belief persistence. It is actually the inability of people to change their own belief even upon receiving the new information or the fact that are actually contradicting their belief. In other words, we may say that this belief perseverance is the tendency of the individual to hold on to the beliefs even when they should not. This says that they do not want to change their base beliefs. The subcategory information processing biases is the category which says and talks about processing errors and describes how information may be processed and used illogically or irrationally, even in all the financial and investment decisions. The other category of the behavioral biases is emotional biases. Emotional biases are the error in the decision making, which is actually arising because of the human emotions, perception, and their feelings about something or someone. Moving ahead with this two category of the biases, we are having number of behavioral biases. Like under belief perseverance biases, we have cognitive dissonance, which includes conservative bias, confirmation bias, representative bias, illusion of control bias, and hindsight bias. Whereas the information processing biases include anchoring and adjustment, mental accounting bias, framing, availability bias, self-attribution bias, outcome bias, and recency bias. The other category, emotional biases, include loss aversion bias, overconfidence, self-control bias, status quo, endowment effect, and regret aversion bias. To understand this all category of the biases, there are certain approaches. There are mainly two approaches which are used by the expert. One which includes the series of questions, and the other approach is the case method. To understand this biases here, we are going to have certain number of questions and the examples. Like smoking is dangerous to health. Tobacco kills us. But still, 1.1 billion people still smoke knowingly it's bad for them. Now, what does that indicate? There are two sides are there. Here, there is one belief and the other are action. It indicates a propensity of cognitive dissonance. Cognitive dissonance occurs when a person believes in two contradictory things at the same time. Here we mention it is injurious to health, but at the same point of time, still action speaks 1.1 billion people are still smoking. When here we are acquiring the new information, it is actually conflicting with our pre-existing understandings. People often experience the mental discomfort when their belief and actions are not in congruence. Over here, this psychological phenomena is known as the cognitive dissonance. So here, as we can see, the action and the belief inconsistency is leading to the dissonance. But now how to mitigate that? To mitigate that, okay, either we are going to change our action, that is quit smoking, or you change your belief. That means you are not believing in the research. And lastly, you can change the action perception. And this is how that will help you to reduce down this dissonance. Cognitive dissonance was firstly published in 1957 by Leon Festinger. And he mentioned that a statement of mental discomfort that arises from holding two different beliefs or values. But what is the effect of this cognitive dissonance? This cognitive dissonance is going to affect your behavior, your decision, your thought process, even your mental health, and lastly, your beliefs and attitudes. People who are experiencing this cognitive dissonance may also notice that they feel anxious, ashamed, and guilty about their actions. And as a result, they may shy away from conversations or the debates about their specific topics to the other people. They rationalize their actions and choices continuously. They try to hide their actions or the beliefs from others. At the same point of time, they also ignore research, newspaper articles, or the doctor's advice that causes dissonance. And lastly, they avoid learning new information that goes against their existing beliefs in their mindset. This cognitive dissonance biases is leading to conservatism bias, confirmation bias, representativeness bias, illusion of control bias, and lastly, hindsight bias. Now, one by one, we are going to look into each of these biases. To understand these biases, we are going to look into certain series of the question, and you are going to assess your choices for each of this action. First question to you. When you recently hear news that has potentially negative implication for the price of an investment you own, what is your natural reaction to this information? There are three options given to us. The first option into that, I tend to ignore the information because I have already made the investment. I have already determined that the company will be successful. Second option, I will re-evaluate my reasons for buying the stock, but I will probably stick with it because I usually stick with my original determination that the company will be successful. And the third option, I will re-evaluate my reasoning for buying the stock and will decide based on an objective consideration of all the facts what to do next. What is your answer? A, B, or C? If your answer is A or B, it may indicate that you are susceptible to conservatism bias. So what is this conservatism bias? Conservatism bias is a mental process in which people cling to their prior views or forecast that at the expense of acknowledging new information. Conservatism bias is where people are emphasizing on their original pre-existing information over the new data. And this can make the decision maker slow to react to new critical information and place too much weight on base information. When it comes about the investment decision, this new information should be looked at carefully to determine its value. But this bias is not going to allow the investor to look at the new data because they are preoccupied with their original data. So this was about conservatism bias. The next bias. Suppose you have invested in a security after some careful research. Now you see a press release that states that the company you have invested in may have a problem with its main product line. The second paragraph, however, describes a completely new product that the company might debut later this year. What is your natural course of action? Just look at the question. You have been given two paragraphs, two information. First information, which is not so positive about your investment. But the second paragraph or the second news is describing something positive about your company. But which data that you are going to look for? What is your natural course of action? So the first thing or the first option is I will typically take notice of the new product announcement and research that item further. And second into that, I will typically take notice of the problem with the company's product line and research that item further. So option A is dealing with the positive news and option B is dealing with the negative news. What you are going to look for? If you are selecting A, you are likely to be susceptible to confirmation bias. So what is this confirmation bias? Confirmation bias is the tendency to seek information that supports a person's beliefs. This bias may lead investors to focus only on the information that is reinforcing their opinion about the investment. They are avoiding the information that might confirm, but crucially, might also overrule the previous decision to invest in the company. So selectively choosing which information to use can lead to the lack of diversification and investment that are too risky for the investor. So this was about confirmation bias, where investors just want to look into what is supporting their original decision. The third bias is representativeness bias. This bias we are going to understand with the help of one example. Investors tend to assume that recent event will continue in the near future and therefore seek to buy hot stocks. What do you mean by hot stocks over here? So hot stocks are the stocks which are performing well in the market right now. They are having the uptrend or the bullish trend. And to avoid the stock which have performed poorly in the recent past, we have Mr. Yash over here. Mr. Yash has invested in automobile sector. At the same point of time, Mr. Yash friends have also invested in the market, but into two different sectors. We have Ms. Sejal, a friend of Mr. Yash. She has invested in FMCG sector. At the same point of time, we have Mr. Shankar, again a friend of Mr. Yash, who has invested in the aviation sector. Now, after this investment, markets have become sluggish. Markets are coming down and overall markets are not performing. So the sectors in the market have also not performed well. And all the sector investments are having certain amount of the losses. Like automobile sector is having the loss of 30%, FMCG is having the loss of 60%, whereas aviation sector is having losses of 90%. Now, as I mentioned, markets are not performing well and all the sectors are having certain amount of the losses. Now, if Mr. Yash wants to reinvest or reconsider some of the investments again in the market based on the past performance of the different sector, he started comparing his holding with the others. As he had invested in automobile sector, he compared automobile sector losses with the losses of FMCG sector as well as aviation sector. And he feels happy because he has comparatively less loss than others too. So he will invest again in the better performed stock, which was automobile sector compared to the other industry, or rather than poor performed stock in the past, which was FMCG sector and aviation sector. So that was about representativeness bias. Now, moving to the next bias, here we have two questions. When you participate in the games of chance that involve dice such as Ludo, what do you feel most in control during the game? The first option that you have been given, I feel more in control when I roll the dice. And the second option, I feel indifferent as to who rolls the dice. That means either you are going to roll your dice or you will not allow anyone to roll your dice. And second option is you are indifferent to that who is rolling the dice. On the similar line, there is second question. When and if you purchase a lottery ticket, do you feel more encouraged regarding your odds of winning if you choose the number yourself rather than using a computer generated number? Again, a situation is given where you are purchasing a lottery ticket. Here, two options are given to you. I am more likely to win if I control the numbers picked. That means I myself select the numbers of the lottery ticket. And the second option is, it makes no difference to me how the numbers are chosen. That means random generated numbers. What are your options in question 1 as well as in question 2? A or B? A, where you are feeling more control with your action, and option B, suggesting you are indifferent to the actions. So what are your choices? If you are selecting A, where people who feel more confident rolling the dice themselves rather than allowing someone else to roll. And in the second situation, respondents feel more optimistic when choosing their own lottery number instead of accepting randomized number, are more likely to be susceptible to illusion of control bias. So what is this illusion of control bias? Illusion of control bias as a source of poor diversification and experimental approach. The first paper published in 2004 by Fellner. Fellner's research showed that investors prefer to make investment in which they believe they can control outcome. This illusion of control bias can lead investors to maintain under diversified portfolio or to use the limit orders and the other such techniques in order to experience a false sense of control over their investment. Next bias. Suppose you make an investment and it goes down. What is your natural reaction to this situation? Option A speaks about, generally I don't fault myself. If an investment doesn't work out, this may simply be due to bad luck. I will sell the stock and move on, rather than pursuing the details of what went wrong. Second option, I would want to investigate and determine why my investment failed. In fact, I am interested in finding out what went wrong. I put a lot of emphasis on the reasons behind my investment decision. So I need to be aware of the reasons behind my investments performance as well. What is your option into this? You are not going to fault yourself, or how you are going to deal with your failed investments when you are making the investment and the values of your investments are coming down. If you are choosing option A, or the respondents who are choosing A, they should be aware about that they are suffering from hindsight bias. Now, what is this hindsight bias? Hindsight bias is a misconception after the fact that one always knew that they were right. I knew it all along. Someone may also mistakenly assume that they possessed special insights or the talent in predicting their outcomes. Hindsight bias is actually very difficult bias to measure because many of us are rarely aware that we are harbor this particular bias. Investors often feel pressure to perfectly time the buying and the selling of the stocks in the market in order to maximize their current return as well as the capital returns. And when they suffer a loss, at that point of time, they regret not acting earlier. So this was about hindsight bias. Now, last section, we talked about belief perseverance biases. Now, this section, we are going to look into information processing biases. And here we start with the bias, and there are two questions are there. Suppose that you are at a warehouse store where you intend to purchase a flat screen television. The model you have selected is priced at 7,750 rupees and you are about to pay. However, at the last minute, you notice a discarded advertising flyer featuring the same television at a price of 7,720. You discover that the offer is still valid. To receive the discount, you will need to drive to a competing electronics outlet about 10 minutes away? Will you get into your car and travel to the other store to take the advantage of the lower price? Yes or no? So here you have been given option. One store which is charging 7,750 and the other store which is 10 minutes away from the existing store is charging 7,720. So here you are having the discount of 30 rupees. What you are going to do? Whether you are going to take that advantage of lower price or not. On the similar line, there is another question. Now, suppose that you are in the same warehouse store and this time instead of buying a flat television, you are buying a mahogany table. The table that you want is costing rupees 4,000 and you are willing to pay. While you are waiting, you strike up a conversation with another store patron who reveals that she has seen the same table available for 3,970 rupees at a competing local furniture store, which is again about 10 minutes away from the existing store. Will you get into your car and drive to the other store to obtain the benefit of lower price? Again here, you have been given the another commodity, but the discounted value is same, which is 30 rupees. And again, the difference is also 10 minutes away from the existing warehouse. What would be your choice? Yes or no? Most of the people in this particular research would probably drive an extra 10 minutes to save rupees 30 on the television, but would not go to the same trouble to save the same amount of the money on the table, while both of the scenarios are having the net savings of rupees 30. Now, why that is occurring? This particular bias is known as the mental accounting bias. When you are having the same amount of the saving, but for the different commodities, you are thinking differently or you are treating your money differently. Mental accounting is a behavior economics concept that states that human place different values on money, which leads to irrational decision making. The concept of the mental accounting bias was developed by Nobel Prize winner economist Richard Thaler in 1999. Thaler had recommended that people should treat money as a fungible commodity and treat all money the same regardless of its origin or its use. Mental accounting often leads people to make irrational investment decisions and behave in financially counterproductive or detrimental ways, such as funding a low interest saving account while carrying large credit card balances. So, this was about mental accounting bias. Next. Now, here one example is given. The question is, have you found yourself having a hard time to place an order when you dine out at a restaurant? Probably yes. Usually, a menu would be offered to you in the restaurant. When we look into the menu, at that point of time, we are finding some of the items are expensive items, some of the items are budget-friendly items, and some more choices you are going to find in between these two values. So for a dinner, generally you choose something in the middle. In this situation, we are implementing anchoring and the adjustment technique. Now this technique is actually involves the tendency to deal with the uncertainty is many situations by something we do know as a starting point, which is the anchor, and then making the adjustment. Here also, in the restaurant, we are trying to identify one anchor which is between highest price and the lowest price. And that anchor is the middle price range. And then the entire meal and order, we are trying to adjust around this middle price range only. This particular bias is known as the anchoring and adjustment bias. Anchoring and adjustment is actually a psychological heuristic that influences the way people intuit probabilities. When it is required to estimate a value with unknown magnitude, people generally begin with some initial default number known as an anchor, which they then adjust up or down to reflect subsequent information and analysis. Anchoring and adjustment bias imply that investors perceive new information differently, and they place emphasis on psychologically determined anchor points. Anchoring is actually a common bias, and it appeals to many of the areas of financial decision making as well. So, from the investment perspective, awareness can be the best countermeasure to anchoring and the adjustment bias. So, this was about anchoring and the adjustment bias. Next bias, where now you have been given two options, and the way certain information has been presented by the company. Here we have been given option 1, where the information says like in quarter 3 our earnings per share, which is EPS, were rupees 1.25 compared to the expectation of 1.27. So this option is saying that company is having or has earned EPS of 1.25, whereas the expectation was 1.27 per share. Likewise, the other option we have been given, where the company has stated that in quarter 3, our earning per share were 1.25 compared to quarter 2, where they were 1.21. Again, I'm repeating, quarter 3 EPS 1.25, whereas in the earlier quarter, company had EPS of 1.21. Now, which option is better? If we closely look at to the both of the option 1 is given in the negative connotation, where option 2 is positive one. Option 2 is actually showing the improvement over the earlier quarter. So option 2 does a better job of framing the earnings report by the company. Based on such kind of the information or the way it is presented as an improvement over the previous quarter, puts a more positive spin on the EPS number. And based on such kind of the positive news, when we are taking the decision, being the investor, that time we are suffering from framing bias. So what is framing bias? Framing bias occurs when people make a decision based on the way the information is presented, as opposed to just on the facts themselves. The same facts presented in two different ways can lead to people making different judgments or decisions. So, this was about the framing bias. Moving to the next question. Now, here we have been given a question. Suppose you have some money to invest and you hear about a great stock tip from your neighbor who is known to have a good stock market sense. He recommends you purchase shares in Microlight, a company that makes a new kind of lighter fluids for charcoals. What is your response to this situation? So here you are getting some stock recommendation from your neighbor who is doing good in the stock market, and how you are going to react to this particular stock tip. There are two options that you have been given. Option A says, I will likely buy some shares because my neighbor is usually right about such kind of decisions. And option B says, I will likely take it under advisement and go back to my house and do further research before making a decision. What is your choice? Are you going to buy the share without knowing further? Or you are going to conduct your analysis and research, and then you are going to make the decision of investments? If you are choosing A, that means you are likely to be susceptible to availability bias. Availability bias. Availability bias refers to the tendency of investors to extrapolate their personal trends and consider them to be market reality. It is called as availability bias because it depends upon the user being able to recall their experiences with the things and the events. Availability bias is the reason that an investor who may have lost money in the share markets start to believe that markets are excessively risky and hence avoids investing in them. So this was about availability bias, where you are just based on your experience taking your financial and the investment decisions. Moving to the next question now. Suppose you make an investment and it does well, but not for the reason you thought it would. You are feeling good about yourself for making this investment. Which of the following would most accurately describe your feelings? Here, the situation is given. You are making certain investments and your investment is performing well also, but not for the reason that you had invested in. In this situation, how you are going to feel about your investment? There are total three options given to you. First option, your keen eye for the good investment is alive and well. Second option, even though the investment did well for the wrong reason, it was still a great investment because you are making money out of that. And the third option, actually, I'm not feeling that great, even though I made money, because the reason I thought the investment would go up did not occur. I just got lucky. What would be your reaction to this situation? In case your response or the people whose responses indicates that their keen eye for an investment is alive and well are likely to suffer from actually one of the bias which is known as self-attribution bias. This is so because an investment success in this case was not due to the good decision making, but to good luck. Self-attribution bias was actually discussed by Terence Odin and Simone Gervais in their article Learning to be Overconfident. It refers to the individual's a tendency to attribute successes to the personal skills and failures to the factors beyond their control. Self-attribution is actually a phenomena in which person disregard the role of luck and external forces in their own successes and attributes success solely to their own strength and the work. Self-attribution is actually a negative phenomenon and that can lead someone to have skills deficits in the short term and failures over long term. It is inherently a negative bias and should be corrected if someone wants to maintain success in their investment activities and financial decisions. So this was about self-attribution bias. Moving to the next question. Imagine that you watch three poker players and how they play in different tournaments for a month. And you have to decide who you will learn from to play the poker after the month. So here you have been given a situation, you want to learn a poker, and for a month you are going to observe three poker players. Player A has won 20,000 rupees, player B has won 5,000 rupees, and player C has lost 10,000 rupees. Which player would you select to learn poker game? Player A, player B, or player C? What would be your choice? So in case you are selecting A, player A, then you are like most other people and you fell victim to the outcome bias. Outcome bias. What does that mean? Outcome bias arises when a decision is based on the outcome of previous events without regard to how the past events developed. This bias does not involve analysis of factors that lead to a previous event and instead de-emphasizes the events preceding the outcomes and overemphasizes the outcome. Outcome bias can be sometimes more dangerous than the other biases, as in that we only evaluate actual outcomes. For example, an investor decides to invest in real estate. After learning, a colleague made a big return on an investment in real estate when actually interest rates were at a different level. Rather than look at the other factors that could have resulted in a colleague's success in the real estate investment, such as the health of the overall economy or performance of real estate, the investor is just focusing on the money made by the colleague. This bias is known as the outcome bias. Next question. Now here in this question, you have been given a list of names. And you are required to answer how many male and how many female names are there. Are more males or more females? So just go through the name. Sarika, Manav, Amy, Anamika, Nishra, Jimmy, Suraj, David, Mitesh, and Darika. What is your answer? The list is actually contains an equal number of male and female names. The male names, however, are concentrated towards the end of the list. And therefore, many of the people would likely to say that there are more male names are there. Therefore, people who suffer from the recency biases are likely to recall that the list was dominated by male names compared to female names. Now, what is this recency bias? Recency bias, or the people with recency bias, tend to put too much emphasis on recent events. This bias may lead investors to think that a current stock market downturn or rally will may extend into the future. So based on the existing performance only, you are taking your decisions. Recency bias can lead clients and the investor to make short-term financial decisions that may deviate from their financial plans. Similarly, if we talk about recency bias, sometimes in cricket, we often judge a batsman or bowler based on his performance in the last series or the last one day international or T20 championship, and not based on their long-term career statistics. Recency bias is also extremely common in the investment decision. For example, an investor invest rupees 1 lakh in a mutual fund. Over the 5 years, the market value of his investment grows to 1,75,000. Then in the last 3 months, the value of the investment falls to 1,50,000 from 1,75,000. The investor may look at his investment performance of as a loss of 25,000 in 2 months and not in the overall profit of 50,000 in 5 years. This is called as recency bias. Investors often stay away from equities when market has fallen sharply, when on the contrary, they should be investing because they can buy further at attractive prices. Recency bias actually clouds our judgment and is detrimental to our financial interest in the long term. So this was about recency bias. Moving to the next bias, and here now we have been given a question. Choose one of these two outcomes. So you are required to choose one option. Option A says an assured loss of 725 rupees. And option B is a 75% chance of losing rupees 1000 and a 25% chance of losing nothing. So one option is stating absolute loss, where the other option is stating certain probability of losing. What would be your answer? The rational response for this particular option can be A. But the loss averse investors are more likely to select B. Loss averse investor. They are suffering from loss aversion bias. So what is it? Loss aversion is a tendency in behavioral finance where investors are so fearful of losses that they focus on trying to avoid a loss more so than on making the profits and the gains. The more one experiences losses, the more likely they are to become prone to loss aversion bias. Like for example, investing in low return guaranteed investment over more promising investment that carry higher risk is called as loss aversion bias. not selling a stock that you hold when your current fundamental of the stock clearly is indicating that it should be abundant as in your investment. And it can be even a selling a stock that has gone up slightly in price just to realize a gain of any amount when your analysis is actually indicating that the stock should be held for the longer period of time for a much larger profit. These are the some of the example of the loss aversion bias in our investment decisions. So this was about the processing biases and information processing biases. Now we are moving our discussion to the emotional biases. So the question is related to the other drivers on the road. How good a driver are you? Below average, average, above average, and option D says well above average. How you are rating yourself. If you are rating yourself as an above average driver, that means that you are susceptible to the overconfidence bias. What is this overconfidence bias? David Brooks wrote in his book, The Social Animal, that human minds are overconfidence machine. The overconfidence is the tendency that people have to be more confident in their own abilities. Behavioral finance has a name for this ego-driven tendency, overconfidence bias. In investing, overconfidence bias often leads people to overestimate their understanding of financial markets or specific investments and disregard the data and the expert advices. This often results in ill-advised attempts to time the market or build concentration in the risky investments they consider as a sure thing. So this was about overconfidence bias. Moving to the next emotional bias. And the question is, how will you rate your own self-discipline? Three options are given. First option, I always achieve a goal if it is important to me. If I want to lose 10 kgs, for example, I will diet and exercise until I am satisfied. Second option, I can often attain my goals, but sometimes I have trouble sticking to certain difficult things that I have resolved to accomplish. And the third option, I have a tremendous amount of difficulty keeping promises to myself. I have little or no self-discipline, and I often find myself reaching out to others for help in attaining my goals. So here is the question about your self-discipline. Are you disciplined? Sometimes you are disciplined, or you are finding yourself very much difficult in dealing with the self-disciplines. What is your option? People who are answering option B or C to any of this question are susceptible to self-control bias because you are lacking self-control. Self-control bias is a human behavioral tendency that causes people to fail to act in pursuit of their long-term important goals because of a lack of self-discipline. Investors with this bias have a large appetite for short-term gains. So this was about self-control bias. The next bias is actually a status quo bias. Status quo bias was introduced by William Samuelson and Richard in 1988. Status quo bias operates in people who prefer for the things to stay relatively the same. What does that mean? Suppose you have been given or offered several sandwich options for your lunch. Individuals generally choose a sandwich they have eaten before. Individuals opt to stick with the status quo, the sandwich with which they are already familiar. This particular bias is named as status quo bias. Status quo bias is actually named after the investor's tendency to prolong or maintain the status quo. In simple words, we can say this means that if an investor is given a lots of options with so many complex and confusing choices, they generally or tend to choose whichever the option extend their current arrangement rather than new or the complex one. And you are going to find such kind of the biases in many of the investors while they are choosing their securities in the market. So that was about status quo bias. Moving to the endowment bias. Endowment effect actually describes that people value items that they own more highly than they would if they did not belong to them. So this is something which is very much related to your belongings and you always value them high. Say suppose you are owning a car and you have been looking after it very well, cleaning it and driving it very carefully. When it comes to the selling your existing car, you don't want to sell it for the average market price because you feel that the sense of belonging. So you try to sell it at above market price. But you are struggling to sell your belonging at above average price. Now, how you can avoid this endowment effect? To avoid the endowment effect, it is very much important that you take the emotional side out of the deal and look at it more objectively from the buyer's perspective. The endowment effect actually describes the circumstances in which individuals are placing higher value on an object that they already own than the value they would place on that same object if they did not own it. This effect can be clearly seen with the items that have an emotional and symbolic significance to the individual. In finance also, this bias can lead to the investor keeping certain assets in their portfolio because they are familiar to them. So even if they become unprofitable or are inappropriate, but still they try to retain this investment. Specifically, you can see some of the investors are having the attraction towards certain selected stocks. So even if these stocks are not giving them any of the profitability since a quite longer time, but still they are going to retain the stocks in their portfolio. But that impact is called as endowment effect, and this bias is known as endowment bias. Moving to the next question now. Mr. Sandeep is going to invest in stock market for the very first time. He was influenced by his friend to invest in the stock market who has earned good returns. Mr. Sandeep invested in a stock as the share market was booming, but the scam affect the market Mr. Sandeep has loss of his hard-earned money as the stock market crashes and bringing down the values of all the stocks. What he'll do next? Mr. Sandeep is having certain investment while markets were good, and he was influenced by his friend to invest in the stock market. But the moment he is investing, thereafter, certain adverse news is outbreaking in the market and markets are coming down. And he is having now losses. What should he do? There are two options are there. First option, he will study more about the stock market and will do proper analysis before investing. And the second option, he will develop a fear about share market and he will even suggest his friends to stay away from the market. So here, one particular option is talking about he should further study about the stock market, make the analysis before the investment. But the another option is suggesting that he should not invest in the stock market and he should also advise to the other people about the same. What he would do? In case the answer is B, then he is suffering from regret aversion bias. Regret aversion bias. What is it? Regret aversion occurs when people fear that their decision will turn out wrong. Regret is actually a negative emotion, and people, particularly, likely to overestimate the regrets. An investor with this bias miss a desired outcomes by their narrow margin trading. So it is very much important to understand that investor can make, there are two kind of the errors. One error that they can make a decision which turn out to be wrong. And this can be called as error of commission because some action has been committed by the investor. On the other hand, an investor can simply miss out on great opportunity by not taking any decision. This can be called as error of omission. In financial terms, an investor may be likely to lose the sum amount of money either by commission or by omission. However, when it comes to the psychological terms, the commission error has a much higher chance of inducing regret. And this is because regret is usually associated with the responsibility for an action taken. So, this was about regret aversion bias. The next bias is affinity bias. Affinity bias is a person's tendency to create a connection or gravitate towards the people who look and seem most like themselves. Further to this, affinity bias may even cause us to avoid or dislike the people who are actually different from us. For example, in the investment, affinity bias can lead to the purchase of the brand name investment option that may in fact charge higher fees for no better performance. A classic example of investment affinity bias is rooted in the local investment, where investors may lose the utility of high return and lower risk from a more diversified and global portfolio. So this is showing the love for the domestic brands and the investment compared to the other country shares and their portfolio. So this was about the different biases, including cognitive biases and emotional biases, and how these biases are affecting our financial and investment decisions in stock market as well as in the other investment avenues. Thank you.